What's going on, guys? Hey, my name is Logan Manzanares, and in this video, I'm going to share with you how you can do owner financing with a loan in place. It's actually called something special. So before we dive into that, if you're new here, please like this video already. It's going to be amazing, I promise you. And subscribe to this channel because we're going to be dropping information videos like this, things you never heard before to provide value to you so you can start investing in real estate today. Let's go. All right, guys, so we're gonna dive into exactly how to owner finance a property that has a loan on it. But before I do, I'm gonna tell you a little story about how I did my very first deal with owner financing. And so this was 2017. Me and my wife, actually, she wasn't my wife at that time, she was my girlfriend at the time. We were looking at buying a house. And so she was out there doing all the hard work. She was putting in offers, she was going to showings, she was meeting with real estate agents, and she was putting offer after offer after offer. And every one of those offers was getting it wasn't getting rejected, it was just getting beat by somebody else. I remember her getting really frustrated. She's like, I put in, an offer over $5,000 over the asking price, and I had 10 other offers better than mine was. She just kept on pushing forward. And then one day, her dad's wife reached out to her and said, hey, I have a deal for you, I think. And so I remember sitting down on their couch, me and my wife, Katie, and they basically presented this offer that we could buy one of their condos that she owed free and clear. And I was just sitting there like, okay, this sounds good. Literally have no idea of what's going on. She was explaining terms to us of their interest rate, of how much we had to put down, of the balloon payment, and all these terms. I had no idea what she was talking about. But I was like, it sounds good. And so our very first deal we did as an owner finance property. Now, the real question in this is well, why would you want to do owner financing rather than going and getting traditional financing? Well, for me, it's really simple. The first one is that when you go to a bank, they have specific terms, specific requirements that they will lend to you as, right? There's no negotiating on terms. There's no really any wiggle room. They have their check boxes, and you have to stay within those check boxes. And so they're also going to check your credit score. They're going to check your debt to income. They're going to check your income, and they're basically going to make sure that you're a really low risk for them to be able to lend you a lot of money. So most people just don't qualify for loans. That's what stops most people from buying homes. Now, the benefits of owner financing is that instead of you having to go to Wells Fargo, Chase, Bank of America, wherever you bank at, and them saying yes or no, you can just go to the owner of the property and say, hey, would you give me a loan, right? And so this could be a friend, this could be a family member, this could be just somebody who wants to sell a home without going through a bank. And so the cool part about going owner financing is that instead of having these pre-structured terms, the owner gets to make the terms. And so they can pick anything from the loan amount to how much they want down, to the interest rate, to the amortization schedule, to if they have a balloon payment or not. And so all these things can be negotiated. And that's what I love about owner financing is you basically can make a win-win situation for the seller and for the buyer. It allows a buyer to get into a property where they might not have a ton of money down, or they might not have amazing credit. And so it just allows each person to have a win-win situation. So that's what I love about owner financing. All right, so the next question is well, can I do owner financing when somebody has a loan on the property? And the answer to that is yes. Now, what that's called is called subject to, right? So basically means that I'm going to take over the title of your property subject to you keeping your loan in place. And so what this basically means is that let's say that you have a loan in place, and let's say that loan's for $100,000, and then I go to purchase a property, okay? And so what happens is that we agree to you keep that loan in your name, and I take over the deed, and I take over the property itself. And so based on our arrangement, basically it allows me to pay you. Again, I could pay you if you have equity in the property, or if you don't have equity in the property. We can basically create terms on how much you want to get paid down. And again, if there's equity on it, then we could also have a separate deal, basically giving you a whole nother check to pay off your equity, or just pay outright. It just really depends on the deal. But the cool part about it is when you go it's from the banking standpoint. What happens when most people buy a home is they go get a loan to pay off another loan, right? And so guess who makes money in that situation? The two banks do, right? And so you actually can save a lot of money, and it allows someone like me to buy a property maybe from you at a higher price if we don't have to go get a loan and pay off another loan. And so basically keeps the money between the buyer and the seller rather than having to go through a third party, which is the bank. And so that's one of the reasons why you'd want to do a subject to. Always the big question that people have when this happens is well, so I have to keep the loan in my name, but you get the title of the property. Yes. They're well, what happens if I want to go buy another property or I want to buy another home? And the answer to that is that, so the way that the buyer buys property from the seller is it goes through a servicing company, right? So they go through a servicing company, and that mortgage is not paid from the buyer to the seller. It's paid from the buyer to a servicing company, and that servicing company pays the seller. And so once you've shown that you have two payments that are serviced through this third-party service, you can go to your new lender if you're trying to get a new loan and say, hey, this loan I have, it's actually being serviced by somebody else. And once you have your first two payments in, 75% of that debt, it goes off your debt to income. So let's say that mortgage was $2,000. After those first two payments are made from the servicing company, you get to wipe off $1,500 of that debt. You only show $500 for the first year. And after that first year, as long as the payments have been made for the entire year, 100% of that debt goes off of your credit, right? And so that's the cool part about that. And at the same time, you're also increasing your credit because you're also having a loan that's getting serviced and it's getting built up, but you're not the one who's actually having to pay it off. So it's actually a win-win situation. And the next follow-up to that question is, what happens if the buyer quits making the payments on that property? Like, won't it affect my credit? Won't it hurt my credit? And the answer to that is no, right? Because what happens is that when you structure this deal, it goes all back to terms, is that you put a performance deed in this contract, right? And this performance deed is basically an agreement between the seller and the buyer. And the buyer says that, hey, for any reason that I get abducted by aliens, or that something happens and I quit making the payments, right? I just ghost you and I fall off the face of the earth and I don't make the payments. And so if that loan goes 30 days late, there's a performance deed in there that says that you can take over the property immediately without having to foreclose, without having to go through any loopholes. Like, it automatically just goes right back to the person whose name is in the loan. And so that basically protects the seller from the buyer if they don't make the payments. And a lot of times, once the sellers understand this, they're like, huh, so you're gonna give me a big chunk of money down, you're gonna make these payments, and then for some reason you flake out, you can make the payments, then I get the house back. And they're like, yeah, I want you to not make your payments eventually, right? Because it becomes a huge situation that they might get all this money down, they might have a loan that's been getting paid down over the course of months, years, and then all of a sudden they could get the house back and they have all this equity, and they could basically resell the house again. And so it actually becomes a huge win-win situation for everybody when you're able to understand exactly how owner financing with a mortgage in place, which again is called subject to, actually works. And so the cool part about doing owner financing or subject to financing is that it all is based on terms. And so it creates a win-win situation for the buyer and the seller, and allows you to come to a place where it can be mutually beneficial. So a seller can sell their house for more, or they can do it in a way that is advantageous to them based on their situation, and also advantageous to the buyer as well. And so that's why I love owner financing. That's why I love subject to financing. And hey, if you want to learn more about how to get creative with your real estate deals, please reach out to me. Let's partner up, let's connect, and let's do some deals together. All right. My name is Logan Manzanares, and I'm out. Bye.